My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. I'll be one to make friends. I'm just trying to save you a little money. My job is not just to entertain, but to educate and teach about days like today. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. Look, I know it's tough, but on days like today, you have to remember that, unlike what you heard, we do not live in China. We do not work in China. We don't even bank in China. Even as our stock market sometimes gets hit on China, with the Dow tumbling 498 points, S&P losing 1.54%, and of course the Nasdaq sinking 1.58%.
The house of pain.
The truth is, it makes no sense for our markets to get hammered by civil unrest in China. We're less intertwined than you might think. Now, some of that's a legacy of the Trump administration's fanatical attempts to get us to source our manufacturing literally anywhere else. But most of it really does come down to the fact that the Chinese government makes it real difficult for foreigners to do business over there. While most tech companies can't escape the reach of China, that's really it, aside from a handful of consumer players, and really a handful, and of course Apple. But today felt like 2011 to me, when we used to sell off on worries about the European debt crisis. Worries that had nothing to do with us at all. Wall Street was convinced that our banks were joined at the hip with theirs. That wasn't the case. Then once Europe turned things around, well, we were up and away. I don't know if China will fix its problems, which comes down to the misguided zero COVID policy. I don't know if they can do it anytime soon. I do know that taking your cue from the chaos is a big mistake. I'll give you some more on that later. With that out of the way, let's talk about this week, okay? The week ahead, which is all about two themes, the fall of oil and the rise of online shopping. The fall of oil comes down to one question. Will the Strategic Petroleum Reserve truly buy back all the oil it's sold at much higher levels? Or will it be piecemeal and half-hearted so as not to move oil up? No matter. You'll want to own some oil stocks just on the possibility after the stunning decline that OPEC Plus cuts back production, which is why we've been buying them for the charitable trust. And you can follow every move we make by joining the CNBC Investing Club, which I implore you to do, because I think you need to know our view on these oils, among other things. While the Chinese economy has slowed dramatically, I believe the strength of U.S. travel alone will buoy the price of crude, as long as the government's really replenishing its reserves and as long as OPEC Plus moves in a positive direction for oil. As for the other theme, the rise of internet shopping, and that leads us to our game plan. Let's start there, okay? Today's Cyber Monday. I think we've seen a gradual transformation to a non-brick-and-mortar based shopping tradition. Think Etsy or Shopify. It caught fire in lockdown, and unlike most so-called COVID stocks, you know, the usual DocuSign, Zoom, Peloton, this continues to be strong this day. Now, look, I've disliked the retail stocks, online retail, for roughly a year now. But at this point, I like the group again, as business never got soft. The comparisons were just too difficult, but that's over. We'll have instant Cyber Monday sales figures tomorrow. The comparisons will be good. You can play it with Etsy or Shopify, or even better, play it with Cramer fave Lululemon. Starting after the close Tuesday, we hear from a parade of companies in the area I'm most concerned about in the entire stock market. Then I think is the weakest and is going to remain the weakest, and that's anything connected to the cloud. Now, it kicks off with Workday, which has been taking share in human resources and financial planning. Not that it matters to the stock, because it could be tough for them to top that last spectacular quarter. Then there's CrowdStrike, which is almost as consistent as Palo Alto Networks when it comes to cybersecurity. Remember, though, Palo Alto pivoted from pure growth to profitable growth. That's why the stock's had a nice run this month. Can CrowdStrike make the same pivot? Be interesting to see. Next, well, we only have one major Fed event this week, but it's a biggie. Jay Powell speaks on Wednesday. I think he'll just obfuscate. I don't mean that in a mean way. I'm just saying that there's an unemployment number on Friday, okay? And it might be really difficult for him to be able to talk aggressive about what he wants to do. That would be good for the market if he did, but frankly, after today's pacing, I think people might be gun-shy. I think they might be too nervous to buy tomorrow ahead of Powell's talk Wednesday. Also Wednesday, we hear from Hormel, which is so much more than spam. Even as spam is iconic, the food stocks have stopped going down, led by PepsiCo and General Mills. Maybe that strength extends to Hormel. Special nod to food inflation here, but also to those who think we'll have a recession. You know why? Because spam does well in a recession. We'll get results from Petco, too. I'm getting worried about this pet health play, as management's been talking a very good game, but hasn't been able to deliver. Each time Petco reports, it gets pummeled. I fear the pattern continues. After the close, we get a remarkable assemblage of enterprise software plays again. Ground zero for the weakness of this entire market. Salesforce starts it off. I think this one's a keeper, even if this quarter may be slow. I'm warning ahead of time. The dollar's now headed in the right direction. That's very good for them. They've got a big-name activist firm pushing them to do better. That's very good for them. Big buyback, too. Salesforce has been the second worst performer in the Dow this year after Intel. I do not think CEO Mark Benioff will tolerate that for much longer. And more important, I do think he has the levers to pull to enhance the bottom line. Okta. Oh, my God, Okta, another once red-hot stock, is bumping heads with a host of cybersecurity outfits, even as they used to have the identity space to themselves. COVID, look, this could be a very difficult quarter. Boy, I used to love having those guys on. I don't know what to say. Like so many companies in Silicon Valley, I think Okta's going to have to learn to live with less. And you know what that means? It means layoffs. And I don't want to predict layoffs at any one company. It's just that because I know that's very frightening for anybody who works there. I'm saying that all of these companies, this table of employment is very high at these kinds of companies. Let's put it that way. Splunk, that's another one where we get a progress report on new CEO Gary Steele's turnaround efforts. He did great for shareholders when he ran Proofpoint. We have to see what he can do for Splunk. Remember, the whole digitizing and analyzing contingent has been hated for over a year. That's about all it has in its favor. I don't know what turns it around except real earnings per share, not profits adjusted for stock-based compensation, and a illusory metric that never should have been allowed because it obscures the real earnings, or lack thereof. At the same time, we hear from Snowflake. I keep telling people this one's run for the long term, not for this quarter. I think Snowflake sets itself apart. They offer a great value proposition, basically renting out the cloud and analytics capability. But it could take a long time for the potential customers to catch on. Although I'm a believer this market certainly isn't as patient as I'd like it to be. One more. PVH, Calvin Klein, Tommy Hilfiger, a little TV shy there. I wish we could find out more because apparel's starting to do a little better. Street loves Dollar General, all right? But have you been to one? I mean, I love the stores, but almost nothing in them is as cheap as it used to be. Nevertheless, the analysts are like a dog with a bone on this one. But not even matter what they say on Thursday morning. They love it so much. Thursday morning, Kroger also reports. I'll bet it'll be good, but why anyone really care about it? Because of the state of their Albertsons acquisition? I think the deal's in jeopardy because Lena Khan's FTC is just not merger friendly. Here's a winner. After the close, we have Ulta Beauty. And from what I can tell, the chain's shooting the lights out. They own the segment, and I don't think it'll quit. I'm looking for a very big beat from the retailer, almost as consistent, by the way, as Lululemon. Great management, great prices. Another tough one that I like, Marvell Tech. Fantastic chip maker, great exposure to data center, networking, storage. The semis are such fallen angels, yet Marvell's incredibly well run, with exposure to the strongest markets. Look, I'd love to be just telling you to buy it, but I don't see the stock catching fire until we work through that chip glut. Even if Marvell has relatively little exposure to the worst areas of weakness, which is consumer. The most important event this week, I buried the lead, perhaps doesn't come until Friday, which is non-farm payroll report. We need to see the unemployment rate go higher while wages remain stable and we get meaningful layoffs in some industries. If that doesn't happen, if the numbers are truly strong, then the Fed heads will come out of the woodwork and start talking about how we need more enormous rate hikes. Bottom line, if the labor report's too strong, we could have a distinctly suboptimal weekend capping off what might be a tough week. Seasonally, it tends to be a little bit weaker before things really take off again come December. David in Ohio. David.
Booyah, Jim. How are you?
Booyah, David. I am good, David. I had a good Thanksgiving. I hope you did, too.
I did. Thank you. My question for you is maybe taking some profits. ExxonMobil, I'm up over 150% from when I bought it. I'm thinking of maybe selling half off and taking some profits.
You must do that. You must do that, David. Don't remember, greed is bad. Discipline trumps conviction. You're up huge. I say ka-ching, ka-ching. Yet maybe even I would say for a third, you want to go half. I'm not going to fight you on that one bit. Congratulations. And how much money people can make in this market. I mean, look, the labor report is key this week. If it's too strong, we could definitely have a suboptimal weekend, capping off what might be a rough week. So I'm just giving you a little warning that this is a tough one going into this day. Mad Money tonight, there's competition in the brick and mortar fitness space. But which company could reign supreme? I'm revealing my power rankings in this space. You want to know it. Then we've had strong performances from the major averages since mid-October. So where could they be headed? And could the Dow continue outperforming? I'm going to take a closer look at sharing what I think you could expect heading into the next year. And by the way, it's pretty shocking. Oh, and then Deere jumped higher on earnings last week. I'm taking a closer look at the farm equipment maker to make sense of exactly what drove the strength. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.